One of the many benefits of being a Mott's Wealth Management client is the opportunity to meet and speak with industry specialists and professionals. Our speaker for the halftime report is Melissa Motts, president of Mott's Wealth Management. She has over 25 years' experience in the tax and financial industry, is a CFP, CPA, and has a master's in taxation. This presentation was recorded on July 27, 2016.
Thanks everyone for coming out on this hot July night to our halftime report. Our next event is our client conference call. Right now it's scheduled for December 28th, but you'll be getting an email update and so forth when the time gets closer. It's a great way to get an update on economic conditions that are affecting your portfolio positions. If you're interested in introducing us to someone, but they haven't been available for one of our events, please feel free to reach out and contact me because I'm available for just a personal lunch or dinner, just to meet in a social setting. Again, I want to give a special thanks to our sponsor from J.P. Morgan, Chad Van Diver. Thank you, Chad. So I'm going to get started here. So I like the title here, Keep Calm. That seems to be the big thing now on all the t-shirts, right? Keep calm, keep calm. So even when we have the UK exiting the EU, keep calm and look for opportunity. Here what we're talking about is how a pendulum swings far from one side to the other. And it's kind of like the markets, it goes to different extremes, and then it's also spends a lot of time in the middle, going from one extreme to another. And as Benjamin Graham here said, the intelligent investor is a realist who sells to optimists and buys from pessimists. And that's always very perfectly said in hindsight. Okay, another Olympic, little bit of trivia. What flag will a team of refugees compete under at the Olympic Games in Rio de Janeiro? So they're a team of refugees. The Vatican City flag, the Olympic flag, the flag of the United States, or the flag of Europe? The Olympic flag. The Olympic flag, that's right. Since they have no national team to belong to and no flag to march behind, they'll still be able to compete. So that's lovely. Oh, and then here's another interesting fact. So for the first time since record keeping began in 1749, Sweden now has more Nielsen's than Carlsons? Roxette fans and ABBA fans, or men than women? What do you think?
I'm going to say men than women.
More men than women. For the first time. Yeah. I guess because they haven't had any big wars in a long time now there in Europe. Europe was so war-torn for many, many, many years. So now more men than women. And has anybody checked out these emojis? Yes, yeah, I'm not even up on that at all. But we're asking which one doesn't have one yet? Justin Bieber or Bieber? Thank you. You can tell how with it I am. Tyra Banks, I say that right? Stephen Curry or Kim Kardashian? Tyra Banks. She does not have one yet. The rest of them have them. Emojis. It's all these new words you have to learn, All right, now we're getting into the nitty-gritty here. So this was up through June 30th. We can see the S&P. We hit our peak. Let me try the laser. Here we go. We hit our peak back in 2000. We know we had a bear market decline there over a 2.5-year period. And then another peak in 2007. And then we all remember the recent decline. Well, not that recent now, back in March of 2009. And then we chopped our way back up. And we're hitting record territory now, as we hear on the news, if you're tuned into that. So the big question always is, where do we go from here? Just looking at some of where things were, one way that stocks get judged as far as how they're priced and whether the pricing is high or low is their price to earnings ratio. So we can see in March of 2000, they were extremely overvalued, 27. October 2007, 15.7, and June 2016, 16.6. So just slightly over where they were in 2007. And we can see the different index levels and where they are now. And one thing that I find extremely interesting is that the yield on Treasury bonds are so low right now. And we're going to go over that in a little bit. We're in a very low yielding world, which is making it very challenging for anyone who's looking at retirement or in retirement to try to make the money last. 1.5% is not going to get you much. This slide is showing, I'm going to show you this area over here, the green bars. These are estimates. So these are estimates of what they think earnings are going to be for companies. So we've seen a decline in earnings in companies overall in the S&P 500. So it's the 500 companies that make up that. And a big drag on it that's really helped cause this decline in earnings has been the US dollar was so high during that period. Because as you see here, the S&P, even though the top 500 companies in the United States that are headquartered in the US, they get 52% of their revenue from the US and 48% of their revenue internationally. So when the dollar is strong, our goods cost more and they don't sell. Okay, they cost more overseas when we have a really strong dollar. So that has impacted earnings. Now the dollar has been pretty stable, stabilized a little here. The estimate is for it to go down. And that would help earnings. So that's part of the reason why they're estimating that earnings will increase again now for companies. And that's a good thing for stock prices. If earnings are going up, then stock prices will go up, typically. And then energy sector, of course, we know, we see that on the gas, when we fill up our car, how gas prices have gone down, oil prices have gone down significantly last year into the first quarter of this year, and how they've turned around. Now they've slumped again. This week they've gone down quite a bit, actually. And we see that when we go to get gas again. We're getting down in the less than $2.10 area. And over in New Jersey, it's in the $1.80s. So, yeah, so we'll see. This is a slide that I always like to just remind everyone of. There's a lot of things going on here, but the main thing I want to just emphasize here is that an intra-year decline, so all these red dots are how far the markets went down. This is since 1980. But then the gray are what they ended up at the end of the year. So we are always going to have declines every year, some more significant. In bear markets like we have here in 2000, 2001, 2003, they were down farther than what they ended up at the end of each year. And, when we're looking at this on a graph and it's past and everything, that's fine. When it's actually happening, it can be very upsetting. It can really, feel very scary. So we had an 11% decline this year. Last year, 12% decline. But we can see our declines in the previous years weren't really that high in comparison, like 6 and 7%. And then we have a 12% decline and people are freaking out. And I think it's because people aren't used to it. And many times they're seeing this. They're seeing 2008, 2009, So that's, that was a once and done thing, hopefully. You have this slide as a handout. And this just shows during the major pullbacks during this current market cycle, so since 2009, 2010, where we've had some big declines and what they've been caused by. So we had a flash crash in July 2010. We had the European and Greece issues. And we had the U.S. downgrade of our credit rating in October 2011. That ended. It started in August. So we had a decline there of almost 20%. 20% is a bear market. That just missed being a bear market right there. So we've had several pullbacks here for different reasons. This, I think, is important too. When you look at this slide, this gray area is the S&P 500. There are declines from all-time highs. So this area, of course, is the Great Depression. And look at this. If you looked at it just like it, that's a big, big, area of this slide. And by comparison, These have been much smaller, even though they're recent and they felt terrible. Okay, they were nothing compared to what happened, back here. So, and we do get these declines. They do happen, but just like that previous slide showed, let me see if I can go backward. This one, we have declines in every year, but generally, in more recent history, the markets go up each year. And then here is a long-term graph set back to 1900 of, where we were. So we can see, back in the roaring 20s, markets really went up. Then we had the Depression, came back up, declined again, and didn't really get back up there again until 1950s. And then we had this big 80s and 90s, really nice bull market. So anybody that retired right here picked a really good time to retire. But we don't know, of course, where we're going to go from here. There have been a lot of talk. Has anybody heard like the idea that it's been so long since we've had a recession, so we're due for one, And what this is showing, the average length of a recession is 15 months, and the average length of an expansion, so recessions are receding, the economy's in a negative, growth mode. Expansions are a positive growth mode, 46 months. And these have some previous expansion peaks in here. So the thing that I like to look at for this, just to give you some sense, is we have a very long expansion. Here's 84 months. However, look at the trajectory of it. The other ones, typically when we would come out of recession, because you have to keep in mind, a recession, we're going down. So it's kind of like that pendulum swinging. Then when it swings back and people start hiring and, things start cranking again, it rises up pretty well. Well, this time it's like the pendulum is just like came back and it's slowly moving. So in that kind of an instance, even though time-wise we've got a long expansion, we are nowhere near the strength of any of the previous other expansions here. So it's okay if it's slow and steady, and that's another thing. To have a recession, you've got to recede from something. We get overheated typically. The economy gets overheated and so forth. That's why we have a recession. It needs to kind of clear itself out. Things have gotten overheated. We haven't gotten to that point. We haven't even, we're just climbing back, just slow and steady. So it's something to keep in mind, as more of a putting it in perspective, kind of thing. This is another, actually a really good sign. Okay, so household debt right here. All right, back in 1980, out of disposable income, okay, so this is your net pay, there was 10.6% of that would go toward servicing household debt. So that would be your mortgage, a home equity loan, those kinds of things. Now it's 10%. It's actually lower than that. So that tells you that there's a significant amount left out of that to pay for other things. So people can, use that. One of the things, though, here, like student debt, has become a significant portion. It used to be much smaller portion. That's become a significant portion. But household net worth, it's the highest it's ever been. Ever. And when you think about the economy as a whole, and you think, oh, there's this problem here and there's that problem there, but many times when you ask people, well, how are you doing? Well, I'm doing okay. Well, we all make up the economy. So if many of us are doing okay, then that's good. Now, it's also been said that many people have been left behind in this expansion. And that's why we're seeing, of course, what we're seeing politically, with lots of extremes going on right now. So in general, people are better off, but many do not feel like they are. Housing, because interest rates have come down so much. Here's the average interest rate on a U.S. mortgage. So this is going back into the mid-90s. we can see how they've come down from 8% down, 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 came back up again for a bit, but now back down, 3.59% average in June. And what that does to housing prices is it makes them go up. Okay? So that's good if you're selling a house, not so good if you're buying a house. But, I mean, how do most people determine whether they can afford a house is what their monthly payment is. And the monthly payments are very low as a percentage. So that's a good thing for the economy as well. Oh, just one other thing back here. I don't know if any of you remember like Ginnie Mae funds. Those are mortgage debts. So the only bad thing about this is if you are an investor and you're looking to earn interest. So on whenever you have a mortgage, you have two sides, right? You have the one paying the mortgage and they're paying a low rate, good for them. Then you have the one receiving the interest, low rate, not so good for them. Okay, and that's what we're running into as pre-retirees, retirees. The income is just not coming in for the mortgages. This is a good, we've had a lot of job creation. So net job creation since February 2010 has been very good. Government has gone down. So that's local governments, state governments, and federal government combined. The labor force participation rate has been declining since 2007, but a good bit of it is aging. We're just aging out. Those of us that are in the baby boom generation, we're retiring and not working. This I put in just inflation. So very low compared with the 50-year averages, very low. And that affects interest rates. It's great for companies, though. It's a great environment for companies, for stock, but not so great for, if you're trying to earn money on bonds and things like that. Yeah, so this inflation, what everybody's so concerned about is deflation. That we'd be in a negative inflation, so prices would go down. So, that's why the Federal Reserve, that's why the governments, in the Eurozone, in Europe, in Japan, et cetera, are trying to keep so much liquidity, so much money out there in the system to try to get people to invest back in and get the economies going again. But if people aren't spending and, you have supply and demand is, almost even, you're not going to get much increase in price. So that's where we are there. And then the oil markets. So that's a supply and demand also. I think the interesting thing about this is if you look here at U.S. production at this line right here, okay, you can see 2013 there were 12.4 million barrels per day, increased to 14.1 to 15. Now dropped down, this is estimated for the year 14.5, and 2017 estimated being 14.4. Look at OPEC. They keep increasing, and they're estimating that they will keep increasing how much they're producing. So here's the total global production, and even though demand is increasing, this is just US and China and then global, so we see global demand going up, 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 projected for 2017, 2016, but demand is still less than supply. Okay, so demand less than supply, the price is going to stick around where it is. Now, what we're seeing is this blue line is for active rigs and this black line is for inventories. So inventories are starting to decline. And they should, because active rigs are going down. Okay, they're not drilling new wells. They're not, putting more rigs out there because the price doesn't justify the cost. So this will equalize at some point. But I think today it was 42 something. I'm not sure what oil closed at today, but it's been down quite a bit since the end of June. And then this is something that is useful, this yield curve, just to see whether we're heading toward a recession or not. If we have a flat flattening yield curve or a inverted yield curve. And what that means is that long-term 30-year rates are lower than short-term rates or about even. That's a flat yield curve, and that's typically telling you a recession is going to be coming. But we're not there. I mean, it has flattened some. You can see from December of 2013, it was steeper. Now June, it's flattened somewhat. But yeah, so we'll see. Another thing that I think is interesting here is this private foreign investor net flows into U.S. bonds. I mean, they've just spiked up. Now they've come down a little bit in 2016, but U.S. treasuries are being bought by foreigners, you know, a lot. And this slide, I think you have a copy of this one as well. Yields below 1%. This is for government bonds with low or negative. So this is of all government bonds, okay? All government bonds. 74% are less than 1% yield. That is the first. I mean, that's a first. And 36% are below zero. They're negative. So below zero means, you know, I loan you $1 million and in 10 years, this is our agreement. I loan you $1 million and in 10 years you're going to pay me back less and no interest. That's what a negative yield is. Okay? So this is the world we're living in now. It's getting kind of crazy. Getting kind of crazy. Yeah. Yeah. And again, you know, like Japan has this going on, Europe has this going on. In the US, we do not have it yet. But we're watching our rates. I mean, how long have you been hearing, oh, interest rates are going to go up? Right? Years now. Ever since 2009. Well, they do a little, but then they, you know, go back down. I mean, we are, yeah, it's interesting. So, so what this does, again, is this puts pressure. It makes, what they're trying to do by having these negative yields are force investors to take on risk. Take on more risk, more risk, more risk, because they can't make it work by being conservative. You know, I mean, I'll show you the last slide. You know, back before 2008, people could use CDs, right? You could put money in CDs and get a decent rate of return, and there's like no risk because you're, you know, it's guaranteed. Okay. Well, you know what CDs are paying now. Yeah, not much. Oh, this is municipal finance. So this is what I was referring to, Frank, the other slide. State and local government debt service. Okay. It's been going down, went down. So they've been paying off debt and refinancing at much lower rates. So that, you know, that's good for, meaning they don't have to raise the taxes, you know. They shouldn't have to, or they should be able to fund the pensions, hopefully, but yeah. And so then, you know, as we're talking about, so if you can't earn money, you know, in something that's very low risk or risk-free because it's just not paying anything, what are the alternatives? You know, where can you put your money to make some money? Well, the best paying asset class yields are maritime, so you know, that's investing in like shipping. That's somewhat risky. Okay, somewhat risky for sure. MLPs, these are limited partnerships, master limited partnerships. Many of them invest in pipelines for transporting fuel and so forth. Again, risky. Preferred stocks, risky. Private real estate, infrastructure, you know, these all have risk. All these that say REIT are all real estate. This is convertible debt, emerging market equity. You know, that got killed last year when the dollar went up so much. So again, risky. And we get all the way down to U.S. equity yields and U.S. 10-year, 1.5%. So you buy a U.S. bond, hold it for 10 years, you get 1.5% per year, you get your money back. You know? So, yes?
On the bonds, is that also savings bonds? Because we've noticed they have lengthened the time they'll mature?
Yes, that's why. Yeah. Yeah, so a savings bond, you put in 25 and get 50 after so many years.
Right.
Well, that's all based on what the interest rate is. So if the interest rate goes down, it's going to take longer to get to the $50. Yeah, totally. And then this is something we've been seeing with gold prices have come up this year. Okay, and it's interesting to me because with that slide I showed you before, but the negative yields and the low yields, gold has always been seen as, why would I put money in gold? It just sits there. I don't get anything. If I put it in bonds, I get my money back. Well, if I'm going to get less than I put in the bond, back, why not put some in gold, So, we are seeing that as a kind of a, just a risk mitigation kind of strategy, to have some money in precious metals. And we can see here, this is the average for all these different commodities. So industrial metals, crude oil, livestock, natural gas, agriculture, silver, gold. So gold is up above the average right now, but many of these are way down, way below where their average has been. So that could be potential for gains there, but again, there's risk involved. There's risk. So this is a 6-month CD, annual income generated. So this is for a full year. So you put it in a 6-month CD, and then it rolls over for another 6 months. So back in 1986, you would have gotten over $6,000. Back in the late 80s, you would have gotten over $8,000. And then they came down, went back up, came down, up. And then now we are getting $370 for $100,000. Okay? So how much do you need to invest to get, to have a living income, Yeah, it's crazy, isn't it? I mean, that doesn't mean, it just means like, you might need to use some of your principal too, to live. It's not like you need to leave every penny to someone, I mean, it's there for your retirement and so forth. But yeah, that's what we're faced with. So that's why we have to take on more risk, and deal with volatility. It's just part of, the world we're in right now. And that was the last slide. Any questions before I turn it over to Chad? I hope I didn't depress everybody. Because there's a lot of good going on too. The stock market, I mean, it's hitting new highs, right? Yeah, and there's a ton of cash. I don't think did I show that here? Look at how much money. I mean, there is so much money in cash. This is in billions. There's so much money sitting in cash. People are really afraid to invest it. But not my clients. They're not afraid to invest it. But the good thing about that is it means there's like you wouldn't want to be in the market if all the money's in and there's no more left on the sidelines, right? Because who's going to buy and keep the price high? Okay? So if there's a lot of money, it's kind of like dry powder. There's a lot of dry powder there that can still come in and keep buying it up. So that's a good thing. That's another good thing. So
what happens at the election, Melissa?
What do you mean?
That was my next question.
In general, let's not talk about this specific one necessarily, but in general, does election cause a drop on a good day? Does it cause a drop or?
Anytime there's uncertainty, okay, uncertainty causes the markets to go down. Yeah. So, yeah, and when it's perceived, to be very uncertain and, who knows, and it could be terrible. Yeah, I mean, I know advisors who have clients that are keeping money on the sidelines until after the election. But that was the same way in 2012. Okay? In 2012, 2013 was a fabulous year. 2012, after the election, things went, or I think right before actually the election, things really went up. So if you were sitting and waiting for everything to line up perfectly before you invest, forget it. Okay, forget it. It's not going to happen. Like they say, the market, it climbs a wall of worry. Okay? So, yeah. Okay, awesome.
I hope you enjoyed listening to Melissa Motz, and if you have a friend or relative who is considering their financial options, please feel free to invite them to accompany you to one of our upcoming events. Visit our website at www.motzwealthmanagement.com for the most up-to-date listing of these events. Over the years, many of our clients have asked Melissa to speak with a friend, relative, or colleague concerning private financial management. Melissa considers it an honor and a privilege and has been happy to accommodate those wishes. For your future reference, please be aware of the standards by which she complies with such requests. First, confidentiality is a cornerstone of our business. Each of our client relationships is distinctly separate and totally private. Second, thoughtful and courteous service is guaranteed. This is a people business. Finally, Melissa will never give advice and counsel to a client without thoroughly understanding his or her needs. Please contact us at 215-513-6240 or send Melissa an email at melissa@motzwealthmanagement.com. Melissa H. Motz is a registered representative, securities offered through Cambridge Investment Research, Inc., a broker-dealer, member FINRA SIPC. Melissa H. Motz is an investment advisor representative, Cambridge Investment Research Advisors, Inc., a registered investment advisor. Motz Wealth Management and Cambridge are not affiliated.